Oh man,
Dobbins.
now I know who you are.
Uh-oh.
Oh, son of a gun. I remember you. Oh, I've been thinking about you because I remember you and I were on a some event together with like 4 of us or something. And 5 of us. And
Like a panel or something.
What was it?
A panel or something?
Yeah. Yeah. And Omar Khan was on there, I think. And I kept, I kind of gave him a little bit of a ribbing. That's what we do up here. We kind, I was giving him a little ride, and I could tell he was getting pissed off by it. But I think you were enjoying it. So I think I remember that part of the story.
That actually sounds like something I would do.
You were letting me go at it. So,
I don't remember it, but it sounds right.
Yeah, exactly. Well, listen, welcome to my award-winning podcast.
Well, thanks for having me.
Yeah, no, this is cool because I had a conversation for the life of me. I can't remember who it was. Are you friends with Paul Moore by chance?
Yeah. Mm-hmm.
Yeah. Okay. Maybe it was Paul. Oh, wait a minute. What do you have the picture in your background for? The P-51.
Oh yeah, that's Old Yeller, Bob Hoover's airplane. That's actually signed by Bob Hoover himself.
Oh, is it really?
It is, yeah.
Okay, so what do you are you a pilot?
Yeah.
What do you fly?
I fly a Cirrus.
Oh, okay. I have an RV-10.
Oh, no kidding.
Yeah.
Oh,
yeah,
super cool.
Yeah, so I had it's funny, I had I bought into the plane. One of the builders had it's experimental. And so one of the builders was moving to Switzerland. So this guy called me up and says, "Hey, my son-in-law is selling half of his plane. You might be interested." I said, "I got 2 kids in college. I don't know." I said, "Okay, fine. Let me talk to the guy." So he gives me the whole thing, and he says, "An RV-10." He goes, "Yeah, and it has a parachute." And I said, "Oh, like an SR-22." And he goes, "Yeah." And I said, "Oh, that's really cool." So I didn't know anything about RV-10s. So I hang up the phone with him. I start Googling it, and those planes don't come with parachutes. And so I'm like, what is this guy talking about? So I go to meet him, and nice guy. And he says, I said, "Hey, I did some more research, and RV-10s don't come with parachutes." He goes, "Yeah, I know. I put it in myself." And I was like, okay.
You're like, I hope it works.
I said, "What do you and your partner do for a living?" He goes, "Well, my partner's an aerospace engineer and I'm a rocket scientist." I said, "I'm
You're
buying
like, okay.
this plane." Okay, that's good.
I'll buy it.
That's good. Better than any $18 an hour mechanic at the Cirrus factory for sure.
Yeah.
So,
Oh my
That's so
gosh, that's
cool.
classic. Love
That's
it. So
good.
how do you like it?
oh, I love it. It's a great plane. Easy to
cool.
fly. I
Yeah.
bought into a Pitts S2A. And do you know what that is?
I do. It's aerobatic airplane, bi-wing.
Yeah, listen, I'm as you may know, I tell everyone I'm 72 years old just to get compliments, but also I felt like a 72-year-old getting in and out of that plane. And I went up and like twice and said, "You know what? I'm out. I don't want to fly this plane. This is not for me." And I just stuck to my RV-10. It's like a Cadillac in the air. So yeah, that was
Absolutely. Yeah. It's a lot of fun to fly. I haven't flown a Pitts. I did fly an extra 300 and that was so much fun.
Yeah. I mean, it was fun, but I don't want to own it. I don't want to go up by myself in it.
Yeah.
It's too tricky, too slippery.
Yeah.
Everyone tells you look out for that plane. So I said, not going to do it. Not going to do it. So
Totally understand. Well, the RV-10's a slippery plane, isn't it?
I have not found that to be the case at all.
Yeah.
It's so easy to handle. I mean, when you pull the stick back, you're doing like an emergency landings and stuff. You pull it back and like, this thing's got to get more than a 10-to-1 glide ratio because I'm going to overshoot the runway on my emergency landing. That's how that thing just floats. It's so easy to fly. So yeah, that's my baby. I haven't been up in a while. I got to get down there and fly it. But when was the last time you flew?
2 months ago, because I went to Hawaii for 3 weeks and now we're moving soon. So I've been busy doing that. So I was actually thinking of going out this afternoon because we finally have a sunny day. Because I'm like, man, I got to get this engine started.
Yeah.
I'm sole owner, so it's like nobody else is flying the thing.
Yeah.
It's sitting, and I don't like it to sit that long.
And mine is practically a sole owner too. My partner doesn't fly it at all.
Is that right? That's
Yeah,
the perfect partner.
I know exactly. Exactly. But
That's
the
the
thing
perfect.
is, the worst thing about it is, whenever there's an expense, I just pay it. And I said, listen, we're pretty loosey goosey on the money. He goes, yeah, I know we are. I said, but I just feel like I'm the one always flying it. I got to pay the bills on it. So he goes, yeah, all right, we'll work on it. We'll figure it out later on. So, but
Oh, that's
that's
cool.
where it stands now. Yeah.
Yeah,
So,
that's cool. Yeah,
um,
I had an SR20 for 14 years, and I sold
okay.
that 3 years ago and bought the SR22 Turbo,
Okay.
and it's a joy to fly.
Okay. So how fast can you get that thing at to?
It cruise at 200 knots.
Okay. All
So
right.
in at like 17,000 feet, it
Yeah.
cruised at 200 knots.
Yeah, I was doing about 190 was the fastest, about 10,000. And I think I had a tailwind, obviously, to get to that, but usually around 150 to 160. It's a fast plane. It's a nice plane. Oh man, now you got me talking, Brian. Okay. Hey, good talking with you. I gotta go.
Yeah, that's the podcast today.
And that is it. That is it here on the podcast for
Yes.
everybody.
The airplane
Signing off.
podcast.
Exactly. All right, so hold on a second. I'm going to get into your story, but mostly what I want to talk about is the reason why I asked you to be on, and it has to do with syndication, and it has to do with, I mean, I love Paul Moore. The guy is so real, and he just tells it like it is, and he, really kind of lays it on the line regarding this whole new cottage industry of passive investors who are going out there, just trying to syndicate just really for the acquisition fee. And they don't know anything about running and owning the property. And you wrote the book on making sure you're doing that right. You're making sure you're putting the money in the right place. So that's I mean, your book, The Hands-Off Investor, Insider's Guide to Investing in Passive Real Estate Syndications. It's awesome. It's great. But I want you to kind of let's talk down and dirty about what's going on in this world. You've obviously been in this business as long as I have, and we've seen them come and go.
Oh man, that's the
Yeah.
truth.
Yeah. So tell me about what it is. How do you choose the right syndicator? How not to be that guy? Not only how not to be that guy on the passive side, but also how not to be that guy as the guy who thinks he's going to go out there and become a syndicator overnight.
Oh, you mean the people that say they have 4,000 doors, but yet couldn't sign a deed on a single one of them?
Oh, really? You think that happens? I tell you, Brian, I get that. I get so many requests to be on my podcast from all those types of people. I'm like, no, not. I don't even want to talk to these people. They've never done a walkthrough of any of their 4,000 units, not even one. And it's like, but they're out there, touting themselves. I think there's some guru out there that teaches that, and that's their model. Yeah, exactly. That type of person. So.
Yeah, it's out there, and sponsor selection is critical, right? When you're deploying capital, it's a very sanitized way of saying you're entrusting your hard-earned dollars with another person.
Yeah.
Because that's really what you're doing when you're making this investment. People sanitize this as if to say like, oh, you put capital in this and capital in that. It's like you worked for that money.
Mm-hmm.
You don't want to see it vanish. So who you put that money with is critical. I mean, if you make the wrong choice, you could lose your entire investment. One of the reasons why I wrote that book was a friend of mine did a 1031 exchange, sold some duplexes that she owned that had appreciated in value. And this was her whole life savings. I mean, she was a grocery clerk. She worked in a grocery store, but she had somehow managed to buy a couple duplexes, and they went up in value. She sold them and put all the money in a TIC. So it was a 1031 approved syndication, essentially, is what that is. And they were investing in assisted living, senior housing facilities. And lo and behold, turns out the guy that was running this syndication was a crook. He had felony convictions for wire fraud and all this other stuff. And he raided the accounts and stole all the money, and she was left with absolutely zero. So her entire life savings vanished, was vaporized. She was set for life, and now she's like, you know, driving for a rideshare service just to put food on the table. And I'm like, I don't want to see that happen to people. So if I could write a book that could tell people what to look for in an investment, it would be worth every minute that I spend on it if it saves even one person from losing their whole life savings. That's how critical sponsor selection is. I mean, there's that old horse and jockey debate, right? You know, which one is it? And I'll say every time, you know, it's the sponsor, not the deal. That's what makes the difference. That's what you've got to choose.
Okay, let me tell you how right that is, because I just got back from the distressed assets and loan workout officers conference down in Florida, and I'm sitting in there listening to all these bankers talk about the deals and what's going on. The number one thing they looked at is sponsor. The sponsor. That is it. You know, when things get going tough, it's who is the sponsor on the deal. And I'll tell you, were you? You know, how'd you do through the last crash, 2008? I mean, I lost some properties, but, you know, I kept them. And the worst thing about it was I had one property. I had 5 GPs with me on the deal. Okay. As soon as we all knew no one was going to make a dime on that deal, they disappeared. My wife and I were the last ones standing. We were the ones that would always answer the phone whenever an investor called. And that's just who we are. But they just ran, as we say here in Massachusetts, they ran like rats, and they just got out of the deal, and we never heard from them again. Actually, one of them did a little gender change. I found out through Facebook. Shows how much I know about my general partners, huh?
Well, I mean, what you got to think about is if you're an investor, and let's say that you guys weren't a group, all doing this together. Let's say you guys were each doing this individually, and you had an investor that invested with you and invested with one or more of your other general partners that were in separate deals. And all this same stuff happened. The ones that invested with you probably would have at least got their money back, or at least got a return phone call. And the ones from the others probably would have lost all their money. So that just shows you how sponsor selection is critical. Now, I know in 2008 was a painful time for me too, but I managed to not lose a single property, not miss a single payment, not lose a nickel of investor principal. And part of that was because I made the sacrifice. You know, I had a deal back then where the property, I used to joke, I would say that half the units are empty and the other half aren't paying. and there was just enough money.
That's 50%. A broker would describe that as 50% occupied.
Yeah, it sure would. And that the 50% occupancy was performing when they were actually doing nothing. But
exactly.
So this property was making just enough money to cover the direct expenses, you know, such as payroll and, you know, and property taxes and whatever. But there was not a dime left over to pay the debt service. So when that happened, I wrote a check out of my own pocket for 15 grand for the mortgage payment. And I thought, I'll do this for 1 or 2 months, right? Yeah. I did that for 3 years. I wrote that check month after month after month. And then that saved the property, right? So finally, fast forward about 5 years, the market was going like crazy, right? And now the value had gone up and I was able to sell it. And not only did I get all of my investors' money back, I got back all of the money that I put in, my $15,000 a month. I got all of that back. It was just an interest-free loan. Right. Yeah. That's how I booked it. And everybody was made whole and even got a little bit of a return. And now I had another choice at that time I could have made. I could have said, this is going nowhere. I'm handing the keys to the bank. We're walking away, and everybody just lost their principal. I could have made that decision. I did not make that decision. Instead, I actually had more money in the deal than all of my investors combined by the end of it because of how much money I'd put in mortgage payments. So that to me, you know, it's a decision that I made because I knew it was a decision for longevity, right? You hand the keys back to the bank, your career is over. You salvage this deal and you're going to get trust for life from future investors, and it's paid off very, very well.
Okay, so let me ask you though, I was in a similar situation and with multiple properties, but some of them, and this is, because this is the type of question that never gets asked because not many people understand the inner workings. I was in a similar situation, but I got to the point during that, after that crash, where I paid the mortgage every month. I paid all the expenses. We always made a little bit of money, not a lot, but then the note came due and the value wasn't there. And I would have had to come up with $1 million on one of my properties just to get the property refinanced. And we just had to drop the keys back in the bank's desk. How did you avoid those situations?
Well, primarily by avoiding short-term maturities. I mean, that's always been something that I've really tried hard to stay away from. And I would say some of it is also luck. I mean, I'm sitting here today as a benefactor of luck because mostly over the last 5 years, we've bought a lot of property. We bought thousands of units over the last 5 or 6 years. And about 2 years ago, I started selling and at what I think is the peak of the market. And I sold 3/4 of my portfolio over the last year and a half before the market collapsed last year, or what I would call a collapse.
Yeah.
Most of those.
Where's your portfolio? What were those properties?
Southeastern US.
Okay.
Mostly Southeastern. So Texas, Arizona, Texas, Georgia, Florida, southern Sun Belt, high growth states.
And like Phoenix?
Tucson.
Okay.
Yep. So, that I think was the right decision, but most of those properties were sold or were financed with low leverage, longer term debt. We had, the shortest loan I'll do now is 10 years. So, we're always doing 10-year loans. But I had, I think 3 or 4 properties that we had bought on a bridge note because they just didn't have the occupancy. They were turnaround plays, kind of heavy lifts. So we had bridge debt on 4 of those properties, and that's 3-year maturity. And it made me nervous the minute we took it out, and I hated every day that we had them.
Yeah.
But we sold all 4 of those properties in 2021 and early 2022. One of them with about a week left on the loan, and the others with maybe a year left on the loan.
So you didn't refinance the bridge. You got out of it.
No, we never refinanced the bridge. We sold out of it. And the buyers that bought from us in all 4 of those occasions, they all use bridge to acquire. And they're all hating life right now. I mean, we've had the brokers try to sell us 2 of the properties, not knowing we were the seller that sold it to them.
Yeah.
And one of them I saw is in a loan modification. So when I say luck plays a role, had we not sold those properties and still owned them today, I would be in a world of hurt, which is exactly why I don't use that short-term leverage. When you run into a maturity, that can crush you.
Yeah, let me tell you, folks, if you're listening to this is the example of 2 old guys talking about multifamily who've been through it all, because 10 years is brilliant. But who do you use? Do you use a Fannie Freddie, or do you use a local lender? You use Fannie and Freddie, so
Agencies,
not recourse. But do you have an issue so you must, if you sell during those 10 years, you're going to do it on an assumption basis. Do you have an issue with the prepayment penalties or defeasance, the yield maintenance?
No, we've always used floating rate debt, which is a 1% exit fee.
Okay.
And so in every case, we paid very, very little to get out of that debt. One thing I didn't want to do is paint myself into a corner and have huge amounts of yield maintenance. Now, with the portfolio that we do have, what's left of what we do have, which is less than 1,000 units now, is on floating rate debt. And yeah, that debt service is crushing right now. And cost of rate caps replacement is crushing. Now, the question, and we get this question a lot of like, well, was it a mistake? Should you have financed all of it on fixed rate debt? Well, today I wish I did, but when we go to sell, it might not be so clear. I still might be glad we did floating rate debt when we sell, because I still won't have yield maintenance to deal with.
Right.
So the jury is still out. But I read a study one time and actually even expanded on the study that was written. CCIM Institute did a study that covered a 50-year time period. And they found that floating rate was favorable to fixed it was, I think, it was around 60% of the period. So if they looked at each month, what you could take out a fixed rate or floating rate loan over a 50-year period, how many of those periods would have been more advantageous to pick fixed over floating? And it showed floating rate won the day by, like, it was somewhere in the 60% range.
Okay.
But the one thing that they did not factor in, and that what they did is they factored these in on a 5-year repayment. So what they did not factor in is if you did a 10-year fixed and paid it off in 5 years and had to have that yield maintenance, now how many of the periods would have been favorable fixed over floating? And I suspect that you would find that 90% of the time floating is going to win the day.
Right.
There's very few short windows of time where taking out a floating rate loan is disadvantageous. And that short window is if rates rise a lot and do so quickly. And here we are. We're seeing that right now. This is the worst case scenario for floating rate debt. And maybe one day I'll regret this decision of having financed our current portfolio on floating rate. But I don't have to worry about maturity. I don't have to worry about prepay. All I have to worry about is interest, which is capped. And that's our biggest risk in our current portfolio.
Brian, how'd you get your start?
I started flipping houses when I was like 20 years old, financing it with like cash advanced credit cards and seller financing. And I didn't have a dollar to my name, Charles.
Yeah. Ron LeGrand teach you, or?
No, I just learned by trial and error, and like read
Really?
every real estate book that was out there. And and then, and it was difficult because I wasn't very good at convincing people to sell their house. So I finally realized, like, I've got to take my negotiation skills and all that stuff out of the equation. So I started buying houses at the foreclosure auction at the courthouse steps.
Yeah.
Because nobody could say no. All I had to do was be the highest bidder. And as long as I was disciplined and stuck to my number, I could buy a property or get outbid, one or the other. It wasn't all this like negotiating with seller and now we have a deal, and then it's time to close and they back out. And, I just had all this stuff. It was like, I was not successful trying to go direct to seller.
That's interesting. That is so interesting. So, all right, quit changing the subject on me. Let's get back to syndication. So what do you look for? Like these guys who are out there doing it now, I was talking to my buddy, Dave Peters. I said, it's like multi-level marketing. It's like all they're doing is getting their friends and family in these deals where they keep a little cut and they can claim that they have X number of units under their name, so they can try to be their own GP someday. But what are the red flags for people to look at? And I'm asking this question for two reasons. First up is, if you're looking to invest with somebody, what are the red flags? And if you're looking to be the guy who wants to be the GP and set up your own syndication to do it the right way, what types of things do you need to stay away from if you're looking to raise money from people?
Well, that's a loaded question. So, well, there's a couple kinds of people out there. I don't know, kinds of people probably isn't the right way to term it, but there's a couple different categories of so-called syndicators, right? It's people who are raising money for the purpose of real estate investments from others. Okay, let's call it that. And so there's one kind is the type that is actively participating in the entire process. This is someone who seeks out real estate, negotiates the purchase, forms the legal entities, raises the money, oversees management in some respect, whether that's directly managing the property or managing the property managers that they hire to manage for them. Ultimately makes the decision on when the property gets sold, manages the resale, makes the investor distributions, right? This is what you'd call like a vertically integrated or an operator type of sponsor, right? Yep. That's one category. That's basically what I do, right? I do. That's
legit. The owner operator. You're the guy, the answer man.
You're the guy. And if you want to know if you're dealing with the guy, all you have to do is ask the person that's soliciting you for money, ask that person, when this property goes to sell, who will be signing the deed? because that's the person who's really in charge, right? That's the
Right.
person that's legally responsible for the
Yep.
entity, who will be signing the deed.
Yep.
Now, and all the assets that we have in our portfolio, you can look up anything we've ever sold. It's my signature on the deed. It's in
Yeah.
public records. It's right
Yep.
there. Now, the other kind of syndicator is one that's just, they call themselves capital raisers or syndicators. And that's the type that raises money from their network, and they take that money and they invest that in other people's deals. Now, there's a couple of different ways that this is done. One is like on a semi-institutional level, there's companies out there that this is exactly what they do. It's called a fund of funds. They raise money from investors, they pool that money, and then they go out and they invest that money with operators. They might, invest 50 to 75 to sometimes 85% of the equity tranche of the capital with operators such as myself to leverage that operator's friends and family capital, right? To allow them to do bigger deals and bring in more money. And there's a lot of companies out there that do this. Now, if you think about like the grander scheme of the bigger picture of financial services, this is like your Blackstones of the world too, right? Blackstone gets money from pension funds, and then they invest in deals that are operated by others, right? I mean, it's a very common model. And then there's a separate subset of this type, which is the one that is raising kind of friends and family money.
Okay, hold on. Before you go to that one, let's back up to the funds of funds.
Yeah.
The first question you said to criteria to use to discern these people is who signs on the deed. When you're looking at a fund-to-fund scenario, what's the criteria you should be looking for there?
Well, what you should be looking for there is basically you want to see that they're financially sound and that they're making solid investment decisions. Because what you're doing in this case, so all of this is about outsourcing, right? If you're an investor and you have $100,000 that you want to invest in real estate, you could go to your local realtor and buy a rental house, put the money down in the rental house, manage it, and do all that yourself. Well, if you don't want to deal with tenants, toilets, and trash, you want to outsource your real estate investing. So now you're going to invest in this passive real estate syndication. You're going to invest with a multifamily operator or an office operator, or an industrial operator, self-storage operator, mobile home parks, whatever it is. You're going to find a company that buys that type of real estate, and you'll invest in an offering that they present to you, which is where they're going to do all the work and all the investors supply all of the capital. That's totally fine. But when you're talking about like these fund of funds, now you're outsourcing the selection of sponsor. So instead of going out and finding the self-storage operator or the multifamily operator or the industrial operator to invest with, you go to the fund of funds and you say, like, I want to invest $100,000 in your fund. You go find the self-storage operator and the hotel operator, you go do that. So that's the ultimate outsourcing, right?
Yeah.
But you got to make sure that you're investing with the right group, because some of these groups, they may not do very good screening. They might just invest with whoever comes along, or they might be investing in bad deals.
Their deal with that fund is better than some other deal that might be a better investment. Because, I mean, speak for a moment about the fund to fund, like those people, they get compensated by the fund for bringing them the money. And sometimes it's a sweetheart deal for some of these guys.
Well, they're the middleman, right? So anytime there's a middleman, they're getting a cut. So if you're the passive investor, you're writing a check, you can invest direct with the operator and cut out the middleman, or you can go to a fund of funds and now you've got a middleman to pay, but they're doing something for you. They're providing a legitimate service in that they are finding the sponsors to invest with. Now, this still is not the category that I think you were originally alluding to, which is kind of like the syndicator.
Because that example that you just gave, guys like Paul Moore fall into that category, and I hold him in very high regard. He does an excellent job for his funds and for his investors in vetting out the quality of the deal. And one of the first things he always looks at is the sponsor. He wants to know.
The sponsor is most critical, right? The sponsor is most critical. And there's large companies out there that do this, MLG, and there's all kinds of major large capital firms that run real estate funds. that solicit money from investors and invest in operators' offerings.
Yeah.
Now, the difference is that they're fully disclosing this is exactly what we're doing. We're investing in other people's deals. We are a fund-to-fund model. We're not in charge here, right? And then the second subset of this kind of other syndicator group is the people that solicit for money, saying that I'm buying this apartment complex and I'm invested in 4,000 units and this, that, and the other. And they're not disclosing that they're not in charge of the deal. They're not disclosing that they're not the one signing the deed. They're not disclosing that they have no decision-making power or any say in how this operates. They're saying, this is my deal, invest in it. And people can get misled into thinking that this is the person they're investing with when it really truly isn't.
Absolutely. And these guys are popping up all over the place. I mean, they show up on my podcast, and not you, Brian, you're the real thing. But they show up on my podcast and start talking to me about being in running these properties. I'm thinking to myself, pal, you've never evicted anybody. You don't know what it's like to show up at the door with the sheriff to get somebody out. You don't have the first clue as to how to run a multifamily property. But that, they look good, and they're doing it, and they keep that cut. And I tell you, Brian, when you and I get started, the SEC would never have allowed these types of guys to operate. And now
that's right.
They're creeping up. I think it was that Jobs Act that created this little cottage environment, and it's going to come back as soon as this market turns. That's when the SEC is going to catch wind of all of this stuff going on and put their foot down.
Yeah, and there's already been some of that. There's it never was legal to do what they were doing, but they found ways around it. So you cannot be compensated for raising capital
on a percentage basis,
on any basis. Yeah, unless you qualify for an exemption. And generally, the exemption that is most widely used is the exemption that you can be compensated for raising capital for your own deal. So, in other words, I can make money raising money from investors for properties I'm buying and so forth, but I can't pay you to raise money for my deal. I can't do that. So the way people got around it is they said, well, Charles, I'll give you a 2% stake in the GP, and therefore now you're one of us. So now it's your deal, and now you can go raise money for it, and your compensation is your 2% stake.
And that goes to the ability to say to the world without fear of being called a liar that you own these properties.
Yeah, a
2% stake that you've never done anything. You can run around telling everybody you own 4,000 doors.
And that's what you see a lot of out there. It happens a lot. And I know that a few years ago there was some big investigation by the SEC on a bunch of groups that were doing this, and surprisingly, I don't even think anything really came of it.
No, are you talking Joe Fairless's group?
No, not specifically. I don't know who exactly was involved, but I know that there was a big investigation of a bunch of people that were raising a lot of money for other people's deals.
Yeah, I had one woman. She was actually on my podcast, and she calls me up all in a panic because she got a target letter from the SEC. I said, "Batten down the hatches, sweetheart, because this is going to get ugly." And she was affiliated with Joe Fairless in that group, and there was a guy in Texas. And when it was all said and done, the SEC said, "Okay, you're all fine. Carry on."
Yeah, that's what I had heard, is that there nothing really came of it. And then they started talking about instituting a rule for capital raisers that would actually allow the practice. So I don't really know where that stands either. I just don't do any of that stuff, so I'm just not that in tune with it.
Yeah. Okay, so how do you do it? I mean, after years and years of being in the business, where does your money come from?
Our money comes from just a broad base of high net worth individuals that have funded us from the early days, and it's just grown by word of mouth. It's funny, I say when I got started in this business, I didn't know anything, I didn't know anyone, and I didn't have anything. And so therefore I was perfectly suited to get into real estate.
Exactly.
But over the years, it's like, I've become to know a few things, and that's garnered the trust of a few people that funded some stuff that was successful. And of course they told people, and then they invested and they told people, and just organically, it's taken me 33 years, but I've been able to grow to thousands of investors. We've had over $200 million, maybe close to $300 million of investors that invested with us. That's grown without me spending a dime on advertising. I don't do any marketing. It's just, natural word of mouth growth.
Okay. Now that brings me to my final point here. First off, anybody listening, you got to check out Brian's book. Okay. You can find it on Bigger Pockets, but also if you do a search on Brian Burke, Burke, on Bigger Pockets, he's got a bunch of great blog posts. And one of them I'm gonna highlight here, and I want him to talk about it. The title is, and this ties in with what I teach all of my members, why you should constantly seek investors and how to find them. So, you're at the stage where, my students get to that point where they don't even have to ask anymore. People just, reinvest with them and reinvest word of mouth. But for those people just starting out, where do you find these people? What's the right way to find them? And like I always say, you said you should constantly seek investors. I tell my members, if you're looking for deals, you got to be looking for investors. And as Jillian Sidoti once said, if you start looking for money, the day you get the deal in a contract, you're too late.
It's too late.
Yep.
Yeah. The same people that say that that's a good practice are the same ones that say that find the deal and the money will come. BS. Okay.
Can I just tell you something? You have dropped 2 slogans in the course of this meeting that make me think that you and I might have had the same guru way back when.
Or at least we've seen the same one.
Exactly. Yeah. When you say tenants, toilets, and trash, that's like one person. That's one person.
Yeah, I don't know where I picked up on that. I've had that one for years. It's just because we've been around too long. I think that's what it is. But it's too late to raise money then. The bottom line is if you're under the gun and you have an escrow clock ticking, you do not have time to raise money, because raising money is incumbent upon one thing and one thing only. And that one thing is called trust.
Trust, relationship.
Trust.
Building trust.
Yes, relationships breed trust. Trust. If people do not trust you, they will not give you their money. And if you have a 30-day escrow, 30 days is not enough time to build trust.
Yeah.
So there's just not enough time. So, I always say there's 3 trust circles that must be closed to get anyone to invest with you. Trust circle number 1, they have to trust what you're doing. So if you're investing in real estate, they have to trust real estate. If the investor's first words out of their mouth is, "Oh, that real estate stuff, that's like catching a falling knife," right then you're talking to the wrong person. They're never going to write you a check.
Can I say that's a 3rd slogan that you've used from that same guy?
Catching a falling knife.
Yeah, is it buying C-class properties like catching a falling knife? You got to get it at the right time, or you're going to get cut.
And that is absolutely true. That goes contrary to everybody that says, "Oh, I buy Class C properties because when the economy is bad, they do the best because they're the last domino to fall, and the A's will go to B's and the B's will go to C's." And it's like, no, what happens is the C's stop paying.
Yeah, exactly. And then they build more properties and the C's become D's. And I tell people, Brian, that I have a bumper sticker on my Mercedes, and I stopped buying Mercedes, by the way. Now I drive a Porsche. But I said, there's a bumper sticker on my car that says, "Life is too short to own C-class properties."
Oh my gosh, I love that.
Yeah.
Yeah.
And I have one student that'll tell me, "Charlie, you're wrong. I made millions with C-class." I said, "Hey, good for you, but I don't want to own them. Life is too short."
Well, even a blind squirrel finds a worm once in a while.
Exactly.
It's like C-class properties will work great until they don't, and when they don't, it's going to be a bloodbath.
Oh my gosh!
So yeah, it's a mess. But I'll finish my trust circles for those who are listening. It caught on that I said I had 3 and I only gave you 1. Yep. The second one is,
I wasn't going to let you go until you
I know you weren't. I knew you're going to circle back on this. So the second one is they have to trust you. If they think real estate is great, I want to invest in real estate, but you're a crook, they're not going to invest with you no matter what, no matter how good of a deal you have. If they don't trust you, they're not going to make that investment. Getting them to trust you takes a lot of time, and it's not going to happen in a 30-day escrow window. I can tell you that right now. The third trust curve that has to be completed is they have to trust the deal. So if they go, I love real estate and I love you, but that property you're buying is a total piece of crap in the worst part of town, they're not going to write a check for it. They have to trust that that asset, that acquisition makes sense and is good. So those are the three things you have to do to raise money. You have to complete all three of those trust circles. Fail on any one of those, no investment. So this is the way most people fail in real estate, is they say, I'm going to go buy this property and I'm going to raise all this money. And they go out and try to raise all the money and they can't raise the money. And why? Because either they're talking to the wrong people, trust circle number one. They haven't established a track record or documented some reason why people should invest with them, trust circle number two, or it really isn't a good deal, trust circle number three. Those are the reasons. And trust circle number one is probably the big one. People, they want to go out and convince everybody to invest in real estate, and not everybody is willing to do that. And then they also want to go and get people they've never talked to before in their whole life, that have high net worth and probably get pitched deals every day, to invest in their deal. And when nobody invests in it, they're like, well, you know, this didn't work, I failed. When really they should be going to people who already trust them, because that's where they're going to find their money.
Yeah, that is great, Brian. That was awesome. I'm so glad I pulled this up on you, because this is what I teach my members as well. You know, you got to start telling the story. When I first got started, you know, we didn't have constant contact. We didn't have any of those things. We just did, you know, blind emails and, you know, blast emails. And when we were getting started, we would tell our friends and family, like, every week, this is what we're doing. And this is what we're doing. We made an offer, didn't get accepted. We made an offer, you know, we did the due diligence, walked away from the deal. And we just built the trust that way. So by the time we got a deal under contract and had gone through the due diligence, and we said, we're ready to raise money, within 9 days, we had all the money we needed from all our friends and family, because they trusted us. They knew what we were looking for, and the deal was a good one. So you're absolutely right. Spot on. So Brian, Burke, I'm so glad to finally reconnect with you, man.
Yeah, likewise. It was fun.
Yeah. Now, where are you located? Are you in Florida?
I'm in Northern California.
Oh, are you really? Where?
Yeah, Santa Rosa in the wine country.
Okay. I got kids in San Francisco.
Oh, nice.
Yeah.
Right on.
Ever been to the Angler restaurant?
No, I tend not to go to San Francisco. I can't find any reason to go there except for the airport.
Yeah. I understand. So, alrighty, man. Hey, great to have you on my show. And I'm going to, get this out there. I actually got to do a YouTube live in about an hour, and I'm going to tell everybody about the 3 trust circles. But I'm going to make it look like I invented it. Okay.
Well, that's okay. I made it look like I invented it, and I'm sure that's not true.
Exactly. Brian, great to see you again. Thanks for being on the show.
My pleasure. Thanks for having me.
Okay, hold on one second. I gotta, one of the things I'm doing is I was speaking to a guy the other day, and not about a month or so ago. And he says, you know, one of the things that multifamily owners are getting killed on right now is their property insurance. The renewals are going through the roof. It's crazy. And I listened to the guy, says the only way to solve this problem is by creating a captive. And I'm like,
yeah.
You know, I've done that before, back in my old insurance days. And, you know, I know how to do that. So the next day I get on the horn. I look at my podcast guest, what form you fill out 5 minutes before I go on for most people. Yours, I looked at it before because I had all this stuff ready to go. But I get this guy, and you know, some people sign up, and I don't even know why they've signed up my podcast. They're boring. And so I said to this guy, I look at it as, oh shit, this guy's in the insurance business. This is going to be painful. This is going to be a pain. It's going to be so bad. Guy gets on the call. I said, hey, I was on my Monday Night Live call with all my members in my program. And the guy was talking about how bad insurance is. He says there's one solution as to how you can solve the problem. And the guy on the podcast says, start a captive. And I said, yeah, that's exactly what he said. I said, how'd you know that? He goes, because that's what we do, is we create captives. And I started talking to this guy. I said, could I create a captive for multifamily owners? He goes, yeah. And I said, what do I need to do? He says, you got to show us that you've got $5 million of aggregated premium, and then we'll talk to you. So I blast out to all of my students. I'm at 3 million right now. And can I send you a form, answer 6 questions, no obligations. And that I'll just aggregate you into to get to my 5 million, because I want to start an insurance company. And all I want to do is multifamily for multifamily owners. And of course, I'm going to cherry pick. I'm not going to do C-class property, and I'm not going to do, Florida.
Yeah, don't.
Yeah.
Yeah, don't.
Yeah. So can I send you the form? It'll take you, you or whatever person you have for the who does your books. All I need is how much premium do you spend? How many units do you have? Give me around the zip codes where they are, and what's the number of units and how much the property's worth total, and that's all I need. And I just throw you in the mix. Could I send that to you?
Yeah, sure. Send it over.
Cool. All right, good. I'll send it over to you, and then we'll see where I go. I might be back in the insurance business, even though I swore I'd never get in the insurance business.
Oh my gosh, I wouldn't want to do that. So good on you.
Well, the only reason why is because this time I'm not the guy sitting at the kitchen table selling life insurance for New York Life. Now, you listen to Warren Buffett, and Warren Buffett said if Berkshire Hathaway had been an insurance company when he first bought it, he'd be worth 10 times more than he is right now.
Hilarious.
So,
yeah.
Because it's such a racket. It is such
it is.
So,
yeah, it is.
Yep. All right, Brian. Hey, good to see you. And
likewise,
I'll catch up
man.
with you. Thanks,
All right.
man.
You got
Bye-bye.
it. Ciao.